Good afternoon. Well, the rebound in equities really resumed last week in style. Equity markets were up as much as 10% over the week and are now up a full 20% or so from the lows. But some markets are actually up even more than that. US equity is up 25%, UK small and mid cap up around 28% from the lows now. So very much a sizable rebound we've seen over the last few weeks. What's driven it? Well, I think number one is the fact that the news in terms of infections and lockdowns has genuinely improved. We've got the infection rates here, and you can see that in quite a lot of countries, particularly in Europe, infection rates have now started to slow. Even in the US and the UK, there's also some good news there. And it's not only that infection rates are now slowing or beginning to fall, it's the fact that in some countries in Europe, the likes of Germany and Spain, lockdowns are now tentatively being eased. And the markets have taken heart from this. Not only that, last week we had the announcement of further policy stimulus, further moves by the Federal Reserve in the States. We had Eurozone finance ministers agree a big stimulus package for the Eurozone. And then finally in Japan, we had another stimulus package announced. So very much the authorities are doing all that they can to try and limit this downturn. Having said that, the fact of the matter is that we are still looking at what is probably going to be the worst downturn this year since the 1920s, i.e. 100 years ago for the UK economy. We could see something approaching a 7% contraction in the economy this year. So the market rally in this sense does, we think, look rather premature. There is still a lot of uncertainty out there. We are still facing a very sizable contraction. And even though lockdowns are now tentatively being eased, this is not going to be a straight line process. I think it's very much going to be a process of lockdown being eased, the authorities pause, wait to see whether infections pick up again. Maybe they do, maybe they don't. So it's very much going to be a stop-start affair. I don't think what we're going to see, or what we're not going to see, I think, is a sort of V-shaped recovery in the economy, a sharp recovery in the economy in the second half of the year, which at these kind of levels, arguably the market is now pricing in. The market is no longer actually pricing in too much bad news. This chart just shows you the price earnings ratio for global equities. And back at the low point in March, equities were starting to look on the cheap side. But I don't think they are anymore. As I've already said, they're up 20% from the lows. Valuations here still look some way below the long-term average. But what this does not take into account is that corporate earnings, are probably going to face further substantial downward revisions. And this means that the underlying price earnings ratio isn't as cheap as this chart makes out. So valuations are not particularly cheap, and yet we are staring at a very severe, albeit probably quite short-lived, downturn in the economy. Where does this all leave us? Well, in terms of our scorecard for equity markets, some of you will notice that this looks slightly different from last week's version, and I have adapted it. Now we are sort of 20% off the low point. And as you can see, quite a lot's been going on. So genuinely, there has been good news in terms of virus infection rates, lockdowns, but equally, we do think the markets have gone too far too fast. And on the back of that, actually, we have taken the decision to sell some equities. We are cutting back our exposure to UK small and mid cap equities, where we have been overweight. We've also had overweight in the UK, and our decision for the moment at least is to park the proceeds in cash. Down the road, if and when markets do fall back, we'll reinvest the money, probably outside the UK, into somewhat higher quality companies. But for the moment, because we do think this rally has got ahead of itself, we think the best thing to do is cut back some of our exposure to UK small cap, mid cap companies, which are particularly exposed to the weak or the downturn in the economy, put it in cash for the time being, with the hope of reinvesting it in higher quality companies down the road. Anyway, that's it for this week. I'll be back again next week. Thank you.